Welcome to the Northbound Wealth Podcast. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast. Hello, everyone. This is Brent Foster, the Northbound Wealth Podcast, weekly market insights. This is the 92nd episode. Today is December 16, 2024. Let's dive in. So stocks finished the week amid book-ending losses around midweek gains as investors digested fresh inflation data, among other things. The Standard & Poor's S&P 500 index slipped 0.64%, while the NASDAQ index ticked up 0.34%. The Dow Jones Industrial Average dropped 1.82%, and the MSCI EAFE index, which tracks developed overseas stock markets, slid 1.48%. Up and down week. Data this week showed the U.S. Consumer Price Index increased 0.3% in November, ticking up from 0.2% in each of the previous 4 months. Additionally, inflation accelerated to 2.7% from October's 2.6% pace. However, both measures were in line with forecasts in a Bloomberg-compiled survey. November's producer prices, meanwhile, rose more than expected as wholesale costs of goods climbed amid a jump in the food component. The U.S. Producer Price Index increased 0.4% month over month on a seasonally adjusted basis in November versus a consensus estimate for a 0.2% increase. Year over year, producer prices were up 3% in November, outpacing the 2.6% gain analysts were expecting. So stocks fell broadly over the first part of the week, leading chip makers who produce semiconductors for artificial intelligence applications were under pressure after Chinese regulators announced an anti-monopoly investigation. Investors breathed a sigh of relief Wednesday morning following news that consumer inflation in November was in line with expectations. Mega cap tech stocks led the rally, so probably the Mag 7, with the NASDAQ closing above 20,000 for the first time. Meanwhile, the Dow fell as healthcare stocks came under pressure. Stocks remained in the trading range for the rest of the week on mild concerns about Thursday's warmer than expected wholesale inflation report and a spending slowdown among lower income consumers. The Dow registered its worst losing streak since 2020. So thank you. Y charts for the weekly market insights data here. Major index return summary. So the Dow year to date trailing number is up 18.66%. MSCI EAFE is up 7.8%. NASDAQ's up 33.50%. S&P 500's up 28.54%. That's that trailing 1 year number. 10-year Treasury note is trading right around 4.40%. And that's down about 0.90% or 90 basis points in the last month. That's up about 20.22% over the last 3-month change. So we're going to keep an eye on that. Hopefully the 10-year note stays at 5 or below, and that will signal good equity markets, I think, over the next year. If we continue to focus on the bond market, that's good data to be following. So the final Fed meeting of 2024. So again, we've talked about consumer prices and inflation. The consumer price index did tick up to 2.7% on an annualized basis in November as expected. The market's rally following the news reflected investor relief. You know, all of us are happy that inflation met expectations and that the increase from the prior month was slight. So the trend is your friend as costs come down. The consumer is in better and better shape. And it also does signal to the Fed that it's working. The high rates that hopefully they can price in some more rate cuts, but get down to a normal level instead of a restrictive level, which will help all of us consumers and small businesses out there. Those two factors may reinforce the belief that the Fed would follow through with the December rate adjustment, which it penciled in back in September. We should learn about that this week. The bellwether inflation measure was the last critical data point before the Fed's two-day meeting scheduled to end on December 18th. So that's beginning now and in the next couple of days. So we'll keep tracking that. The S&P 500 index benchmarked ended Friday's session, so close of Friday's trading at 6,051.09. So above 6,000, and we've kind of been hanging out there for a while. And this snapped a 3-week winning streak. The S&P 500 is still solidly in positive territory for 2024 with a year-to-date climb of 27 to 28%. Up again today, this morning, as I'm looking at it, we're up 41 basis points. This is Monday, December 16th, and we're at trading around 6,075. All right. The materials sector had the largest percentage drop across the S&P 500 sectors, shedding 2.9% on a weekly basis, followed by a 2.7% decline in utilities and a 2.4% loss in real estate. Nucor, ticker symbol NUE, shares were the hardest hit in the materials sector, falling 12%. UBS downgraded its investment rating on the stock to neutral from buy and said it sees limited upside in the near term for the stock. The firm also cut its price target on Nucor shares to $156 each from $171. In the utilities sector, shares of Pinnacle West Capital, or PNW, slipped 4.4% as the company said the chairman and chief executive of the company and Arizona Public Service, Jeff Goldner, would retire on March 31st. Ted Geisler will become the chairman, president, and CEO of the Pinnacle West and Arizona Public Service effective April 1st, the company said. Still, communication services rose 2.4%, and the consumer discretionary sector edged up 1.4%. In communication services, shares of Warner Brothers Discovery, which is ticker WBD, jumped 13% on the week as the company announced restructuring plans. Warner Brothers Discovery plans to implement a new corporate structure that will split operations into two divisions: Global Linear Networks, which is focused on the profitability and cash flow, and then Streaming and Studios, which is targeting growth through streaming and entertainment. Again, the FOMC meeting will be the main focus this week. Also, economic reports will include the second revision to Q3 gross domestic product, November U.S. retail sales, housing starts, building permits will also be released, among other data, basically to close out the year. This week, again, key economic data. Tuesday, the FOMC meeting begins, retail sales, industrial production, business inventories data. Wednesday, housing starts and permits, FOMC announcement, Fed chair press conference. We'll be watching closely. Thursday, GDP, existing home sales, weekly jobless claims. Friday, personal income and outlays and consumer sentiment. Notable companies reporting earnings: Micron on Wednesday, Thursday, Nike, Cintas, FedEx, and Paychex. And then tax tip of the week. Have you created your IRS online account? The IRS makes it easy to create an online account where you can view all kinds of account information, such as your payoff amount, the balance if you owe taxes, your payment history, key information from your most current tax return, so like transcripts, payment plan details if you have one, select IRS notices to inform you, and then economic payments if you have any, and then your address on file with the IRS. You can even pay online and receive a digital copy of your most recent tax return transcript. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. This tip was adapted from irs.gov. Stay tuned for the next segment. Here are some things that you need to know. Healthcare costs are a key consideration for everyone preparing for the future, regardless of where you are in your retirement journey. For many, transitioning from employer-sponsored health insurance to navigating Medicare or private plans can be challenging. Understanding these costs can now help you make more informed choices down the road. So here are some key considerations. Number one, rising healthcare costs. Healthcare expenses consistently outpace general inflation, driven by increasing longevity, technological advances, and growing demand. Preparing for these costs today may help you better manage unexpected financial strains in the future. A lot of what we bake into plans for us is around 5 to 7% inflation rate on healthcare expenses. So keep that in mind. Number two, understanding Medicare's role and limits. Medicare provides essential coverage beginning at the age of 65, but comes with gaps. Supplemental insurance can help cover out of pocket costs and additional needs like dental, vision, and hearing, making it an important piece of any healthcare strategy. Number three, coverage options before age 65. So, bridging the gap before Medicare eligibility is critical if you plan to retire early. Options like COBRA, a spouse's insurance, or private plans can help you cover during these periods, but it's important to consider the potential costs, which can be high. Number four, preparing for extended care. So extended care can be a major expense that many overlook. Whether you need home health care or nursing facility services, having a strategy to cover these costs is crucial. Irrevocable trusts and long-term care insurance are just some of the ways that you can help manage your estate while providing quality care. Number five, estate and legal considerations. Essential documents such as medical powers of attorney and living will play a key role in managing healthcare decisions and protecting your wishes as you age. Having these in place can help your loved ones. Number six, beyond insurance, exploring broader options such as holistic health management, medical tourism, and the use of technology for health monitoring can contribute to overall well-being and may help manage extended healthcare costs. Transitioning from employer-sponsored coverage to Medicare or other private options can be emotionally and financially challenging. Whether you're years away from retirement or approaching it soon, preparing for healthcare should be an essential part of your financial strategy. Our role in your healthcare strategy is we can assist in projecting healthcare costs and integrating them into your retirement or financial strategy, exploring tax-efficient strategies for healthcare savings, for example, like HSAs and different things like that, evaluating the impact of healthcare costs on your estate management. So what does that mean for legacy planning? If you'd like to discuss your healthcare needs and how they fit into your broader financial strategy, please feel free to contact us and schedule a meeting. Wishing you a healthy and wonderful new year. So there's this really good book that I'm reading. Wanted to share an excerpt from it. It's called Just Keep Buying: Proven Ways to Save Money and Build Your Wealth by Nick Majuli. I think I said his name right. But check this book out. Go to Amazon, get it, read it. I think it's a good one. But there's this excerpt, and it's called How to Win the Time Traveler's Game. And I thought I'd share this with all of you. Hopefully you get something out of it. I imagine you are approached by a time traveler who has a keen interest in learning how to get rich. To this end, the time traveler has devised a game that they want you to play, which goes as follows. Tomorrow, you will wake up at some point in the last 100 years with no knowledge of your current life and no knowledge of what the future will hold. However, you will be allowed to give yourself a specific set of financial instructions to follow. Assuming that you want to maximize the probability of building wealth, what would you tell yourself? Well, it's tempting to say things like, buy Apple, or avoid the stock market from September 1929 to June 1932. Let's assume that history won't repeat itself in the same way. You could go back to 1929 and never experience the Great Depression, or to 1976, and Apple never makes it out of the garage. Given this limited information, what instructions would you give yourself today to take with you into the past? How would you win the time traveler's game? To answer this question has been this book. Given that I don't know anything about you, my goal has been to maximize the probability of your financial success, regardless of your background. With this in mind, let's review the specific set of financial instructions I would tell myself to win the time traveler's game. These are the Just Keep Buying rules. That's the name of the book, by the way. Just Keep Buying. So, saving is for the poor. Investing is for the rich. Find where you are in your financial journey before deciding where to focus your time and energy. If your expected savings are greater than your expected investment income, focus on savings. Otherwise, focus on investing. If they are similar, focus on both. That was in chapter 1, by the way. Save what you can. This is in chapter 2. Your income and spending are rarely fixed, so your savings rate shouldn't be fixed either. Save what you can to reduce your financial stress. Chapter 3. Focus on income, not spending. Cutting spending has its limits, but growing your income doesn't. Find small ways to grow your income today that can turn into big ways to grow it tomorrow. Chapter 4. Use the 2x rule to eliminate spending guilt. If you ever feel guilty about splurging on yourself, invest the same amount of money into income-producing assets or donate to a good cause. This is the easiest way to have a worry-free spending. That's chapter 4. Chapter 5, save at least 50% of your future raises and bonuses. I happen to like this one a lot. Don't live up into your bonuses. Save half. A little lifestyle creep is okay, but keep it below 50% of your future raises if you want to stay on track. Chapter 6. Debt isn't good or bad. It depends on how you use it. That's true. Debt can be harmful in some scenarios and helpful in others. Use debt only when it can be most beneficial for your finances. Chapter 7. Only buy a home when it's the right time. Buying a home will probably be the biggest financial decision you ever make. As a result, you should only do it when it fits into both your finances and your current lifestyle. That's chapter 7. Chapter 8. When saving for a big purchase, use cash. Though bonds and stocks may earn you more while you wait, when saving for a wedding, home, or other big purchase, cash is the way to go. Chapter 9. Retirement is about more than money. Before you decide what to retire from, make sure you know what you want to retire to. Chapter 10. Invest to replace your waning human capital with financial capital. Couldn't agree more with this one. This one is underappreciated by a lot of people. And then when they discover it, it's amazing. So there's financial capital, and that can replace your waning human capital because you can only make money for so long. You won't be able to work forever. So replace your human capital with financial capital before it's too late. Investing is the best way to accomplish this. Could not agree more with that. Chapter 11, think like an owner and buy income-producing assets. To really grow your income, think like an owner and use your money to buy income-producing assets. Period. That's chapter 11. Chapter 12, don't buy individual stocks. I happen to disagree with this one. But that's okay. I don't have to agree with everything. Buying individual stocks and expecting to outperform is like flipping a coin. You might succeed, but even if you do, how do you know it just wasn't luck? Well, most of the indexes that are out there have certain weights of certain companies and stock, and over periods of decades, they can do very well by both owning the index and by owning the individual stocks. So I agree with not being speculative. I'm just stock picking, closing your eyes and throwing it at a dartboard. But there is actually a way to go about investing in the equity markets. You could always hire someone too, like Northbound Wealth Management. So chapter 13 and chapter 18, buy quickly and sell slowly. That's a great rule. Since most markets are expected to rise over time, buying quickly and selling slowly is the optimal way to maximize your wealth. If you don't feel comfortable with this, then what you are buying or selling might be too risky for you. This is true, right? Chapter 14, invest as often as you can. If you think you can time the market by saving up cash, think again. Even God couldn't beat dollar cost averaging. That's chapter 14. I know he meant that last little statement as a joke because God could beat any kind of investment strategy anytime, but I know what he was meaning by that. Investing isn't about the cards you are dealt, but how you play your hand. I guess that goes to the gambler, the song. You got to know when to hold them, know when to fold them, know when to walk away, and know when to run. Better count your money when you're sitting at the table. There'll be time, I think, to count them when the dealing's done. It might be that. You will experience periods of good and bad luck throughout your investing career. However, The most important thing is how you behave over the long term. That's chapter 15. Chapter 16, don't fear volatility when it inevitably comes, because volatility always comes and goes. Markets won't give you a free ride without some bumps along the way. Don't forget that you have to experience some downside if you want to earn your upside. And that is true. There's always risk up and down to any investment. Market crashes are usually buying opportunities. That's chapter 17. Future returns are usually the highest following major crashes. Don't be afraid to take advantage of these crashes when they periodically occur. Absolutely correct with this. Whenever there's a market crash, you head into that storm and you assess how much you can afford to deploy. You don't have to deploy as much capital into those situations because you're buying more shares at a cheaper price. If you follow me, you could pick your spots and find ways to deploy capital during a crisis. It's actually a really wise move. That's what smart investors do. All right, chapter 18, fund the life you need before you risk it for the life that you want. So true. Though this book is called Just Keep Buying, sometimes it's okay to sell. After all, what's the point of building your wealth if you don't do anything with it? Very true. Chapter 18. We can sometimes get caught up in saving so much and not thinking about why we're actually doing it after a while. Just get used to it. Chapter 19. Don't max out your 401k without considerable thought. The annual benefit of a 401k can be less than you think. Before you lock up your money for multiple decades, consider what else you might need it for instead. Chapter 19. I actually think that's true. You really do need to think about how you're deploying your capital, and because it does have long-term impacts. And too much in a 401k can leave you a little feeling like, gosh, I don't have enough money to go do some things that I wish I had money for, but I have all this money in a 401k. Well, you can't touch it till you're 59 and a half, technically, without taxes and penalties. So why are you doing that? You could have maybe bought a company or invested in real estate outside of an IRA or 401k environment. So consider those factors. You'll never feel rich, and that's okay. This is so true. No matter how successful you get with your money, there will always be someone with more. If you win the financial game, make sure you don't lose yourself in the process. Chapter 20. Chapter 21, time is your most important asset. You can always earn more money, but nothing can buy you more time. So true. Okay. And finally, the financial game that we are already playing. Fortunately, we don't need a time machine to play the time traveler's game because we're already playing it. In fact, we've been playing it for our entire lives. Every day we have to make financial decisions without knowing what the future holds. And though we don't have a specific set of instructions to follow, we are constantly searching to find the best information we can. The fact that you've read this book demonstrates that you are trying to find the set of instructions that will work for you. I can only hope that Just Keep Buying has made the list. Thank you for reading. So, Nick Maggiulli, great job. This book is excellent. I'm so glad I had an opportunity to read it. There's a lot of good content in here. And that's what I want to share with my audience, the Northbound Nation. Thank you for listening. On to the next segment. As the year draws to a close, consider the impact your charitable giving can have, whether it's maximizing tax benefits, simplifying donations with a DAF, which is an acronym for Donor Advised Fund, or supporting your favorite cause. Now may be a perfect time to give back. So consider your year-end giving. You have a couple of weeks to get that done and make an impact on a nonprofit charity 501c3 of your liking. Here's a CNBC article I posted out there on socials regarding homebuyer demand for mortgages jumped 6% as interest rates fell to the lowest level in over a month. So this was published December 4th on CNBC, and I put it out there on like the 10th, just not too long after that. But given that today's the 16th, I thought I'd chat about it. The average contract interest rate for a 30-year fixed rate mortgage with conforming loan balances is around $766,550 or less, decreased to 6.69% from 6.86%. What that says is basically if you're below a loan note of 766,000, which is like around the jumbo level, you're around 6.69% on the 30-year. So that's what you're going to pay in interest. But applications to refinance a home fell 1% for the week and were 7% lower than the same week ago. So kind of trending down on the refis, but potential home buyers are responding to lower mortgage rates and a higher supply of homes for sale coming on the market, which is actually something we anticipated here at Northbound Wealth Management. I think that's only going to pick up steam as we head into the spring and get past winter, and we'll see more and more supply come on the market. And with the Fed lowering rates, that should help fuel a lot of activity. So that fueled mortgage rate demand last week as consumers were looking to refinance. Those pulled back. Total mortgage apps, though, the volume rose 2.8% compared with the previous week. And according to the Mortgage Bankers Association seasonality adjusted index, an additional adjustment was made for the Thanksgiving holiday. This is all a little bit lag because you got to wait for the data to come in. The average contract rate, again, was 6.69%. Applications for a mortgage to purchase a home jumped 6% in just that 1 week. It's the highest level since January. Applications were 21% lower than the same week a year ago. And that makes sense because rates have been high. Not a lot of people are out there applying for mortgages. But as that number starts to decline, we expect here at Northbound that trend will start to rise. So keep that in mind as you're out there thinking about the new year and what the plans are for your family to be buying or selling a home. Now, legacy is more than financial assets. So think of giving money away, what values, traditions, or memories that we pass down, the pieces of ourselves that end up living on. For many, this time of year can also bring the weight of loss and the absence of loved ones. Yet the true power of legacy is in how it continues to shape us even when those who created it are no longer there. Here are a few ideas families have shared that may inspire you to start some new traditions. A family recipe book. So collect cherished family recipes and print them in an official family recipe book. That's always a special and good idea. Annual family reunions. Gather regularly at a favorite spot to strengthen bonds and create lasting memories. Volunteer together. Each Christmas, pick a family in need of support and teach the value of giving back, which is also a value of breaking the power of money in your life and in your kids' life. Holiday crafting or baking. Bake the same sweets or craft ornaments each year to create tangible memories. The most important legacies are built on love, traditions, and unforgettable experiences, those precious pieces that live on beyond us. What traditions do you hope will continue with your future generations? And just to wrap up, on behalf of our firm, we want to wish you and your loved ones a joyful holiday season. As the year draws to a close, we are genuinely thankful for your trust in our team. We view our role as more than managing your investments. It's also about supporting your life goals, preparing for your family's future, and helping to create your legacy. We hope this holiday season brings comfort, connection, and memories to those closest to you. Our commitment to giving you confidence in your financial goals and your life's dreams never wavers. Thank you for allowing us to be a part of your financial journey. We wish you and your family warm holidays full of laughter, love, and celebration. Here's to and cheers to a happy new year ahead. Please reach out to Northbound Wealth Management anytime. We're always thankful to serve you.